So the Federal Reserve just raised the Fed funds rate by 75 basis points. This was something that was not expected until about 2 or 3 days ago. So last week, the CPI data came out showing that we were having bigger inflation than everybody thought. They needed to do something big because we had big market days down on Friday and big market down day on Monday. So the narrative picked up that instead of a half a basis point, 50 basis point bump, we were going to get a 75 basis point bump. Now, why do they do this? It's obviously to prevent this runaway inflation. If you've been shopping at the store, if you've been getting your gas, you notice that inflation is on the rise and it doesn't seem to be going anywhere. With the low unemployment numbers, with the big number of job openings that there are, with all of these little things that are being pieced together, they need to do something, and raising the interest rates is exactly what they need to do. Now, they also need to start trimming their balance sheet. During COVID, the Fed went out and printed $13 trillion and put it into the market to help the average American family, help the small mom and pop businesses. Seemingly, they did it without a plan. And the repercussions are now that we are getting this type of runaway inflation. So this is everything that is going into this. Now, why does the stock market not like rate increases? Now, today, this reaction that we're seeing, the stock market is up right now. And I think that the reason that the market is going up is because the forward guidance that Jerome Powell did give, and we'll get into that in a second. But why do markets not like raising interest rates? Because mostly the tech stocks have been leading this market. You look at your Apple, your Google, your Microsoft. Those companies, those types of companies really like to borrow at extremely low rates because they borrow so much money. So as you start getting these types of companies that cannot borrow as much anymore, means they can't grow off of this very low debt anymore, means the stock market starts to come down. Not only that, it's an issue of GDP. So we have you and me out there that go and borrow for cars, go and borrow for homes, go and borrow for starting a small business, whatever we need to do. Obviously, it's getting more expensive, meaning that there's going to be less GDP that's going to be spent. Obviously, me and you, we can't go out there. The average American, if you go out and buy a home that is, call it $200,000, if they raise your interest rate from 2.75% to 5.25% for a 30-year fixed mortgage with 20% down, that makes a big difference in your monthly payment, maybe $200 or $300. That every single month, that is going to cause a big issue. So less mortgages, less car rentals, less car loan or leases, whatever you want to call it. So what do you do? Guys, it is getting very scary out there. We have this inflation. We have interest rates that are coming on the rise. I need you guys to save, save, and save. The average person out there needs to button up their belt. And we've said it so many times on this show. Paul has said it so many times on this channel. The average American needs to save because in times of, we have had a decade of really good times out there. This is the other side of the pendulum. When you get the pendulum swinging, here's your pendulum. These are your euphoric highs and these are your depressing lows. And this pendulum has been up here for a very long time. And it is going to swing right back to this side. This is what we're seeing right now. This is what we're seeing with this type of inflation, raising interest rates, joblessness that we're seeing. It is becoming a very difficult situation out there. So don't borrow if you don't have to. Don't refinance if you don't have to. I just saw that the average mortgage rate right now is going for 5.65%. I'm going to put that in perspective. 1 year ago today, I closed on my house, the same date, June 15th, 2021. My interest rate for a 30-year fixed mortgage was 2.75%. Today it's 5.65%. So do not borrow if you don't have to. Do not refinance if you don't have to. Take advantage of this market volatility if you are an investor that goes into individual stocks. This is the time that value investors have been waiting for a very, very long time. This is the time that traders have been waiting for a very long time, like myself. Now, if you're the average person out there that just wants to invest in ETFs, do not deviate from your plan. If the market goes up 10% in one day, and that is your day to buy ETFs, you go and buy your ETFs. If the market is down one day 10%, and that is your day to buy ETFs, go and buy your ETFs. Because over the long period of time, remember, you are going to be just fine. So what comes next? The Fed needs to do whatever they can to regain credibility and control this runaway inflation. They need to use all tools possible. And they said that they foresee themselves in the next meeting, which comes in August. There's one in September, there's one in November, and one in December. In those coming meetings, they see themselves raising the interest rates to get to 3.4% by the end of this year as the federal funds rate. So 50-point basis hikes and 75-point basis hikes are on the table going forward. Do not get scared. Everything is going to be okay. They need to continue to taper that balance sheet. They need to hope that they keep cutting. We need to hope that they keep cutting their spending because their balance sheet has been out of control, $13 trillion that they need to get rid of. And in my opinion, when we start seeing food and energy prices coming down or becoming stagnant and hitting those peaks, a lot of you are paying $6 a gallon right now. When we start seeing those types of inflationary areas start settling down, that is when inflation is going to start taming itself. That's when they're going to be coming back to new normals. But as far as stocks go, buy them up when they're low, buy them up when they're in your value position. And one more concern that they need to get rid of is stagflation. Stagflation is when you have slowing GDP and inflation running away. That is a combination that we haven't seen since the 70s, and it is a very bad combination because things are expensive and people aren't spending as much. You can't spend as much. It becomes a vicious cycle and a disaster. We have not seen this since the 1970s. There are a lot of economists out there that are predicting that stagflation could be around the corner. This is something that the Fed has to tame. I'll catch you on the flippity flop.